Hello, hello. Welcome to the Canadian Money Talk. If you have any questions about personal finance, investing, feel free to join. Canadian stuff, ideally, but I can look up American stocks for you too. If you have any questions about personal finance, investing, financial independence, all that good stuff, feel free to ask. Hello, Ranch. How are you? What can I do for you? Tariffs going on. We had an interest rate cut today. I'm good. I just took her to the dog park, came back about a half hour ago. So I'm hoping she's going to leave me alone for the duration of the live. Good time to buy CNQ. What did I do with CNQ? I have a call out on CNQ actually expiring in a week and a half at 46. I think that's going to expire worthless. Let's see. CNQ. I own a significant amount of it already. CNQ. I sold a put on Synovus. So if Synovus goes down, I'll get some more. Yeah, I mean, with the price of oil, CNQ has come off. So have all the oil companies. Looks like they've got a nice, CNQ does a nice little jump back upwards. Nice dividend yield at these prices. P of 14 isn't as low as it used to be, but it's not outrageous. So yeah, I could see CNQ. I don't really know if I want to keep accumulating huge amounts of, well, anything, but like oil stocks, but I definitely like the dividends they pay. So yeah, they've come off, but looking at the 52-week chart, they always come down and then come back up a little bit, come down, come up a little bit. So this could be another false start. They just keep making lower lows and lower highs. And what is oil at now? Oil went up a little bit today, 67, almost 68. So it's not great. Yeah. All the oil companies depend entirely on the price of oil. So as oil has been trending downwards, so has their share price. Obviously, you still have good companies and bad companies, but yeah, it hasn't been that easy for them. That's just what I don't like about commodity producers, is that they depend entirely on the price of their commodity. And so they're competing on lowest costs to get it out of the ground. Rand says stocks were tanking due to tariffs. That's true, or uncertainty, you could say. But then bounced after inflation numbers came in okay in the US today. They did. What you think of the future holds for stocks? Like I just bought into. So Neptune, I don't know what you mean, but if you say something like that again, I'm just gonna ban you. I don't really need that. Yeah, so like I'm still financials and energy, renewables, I'm still very good with. And then some US growth stocks, like I'm looking seriously at a little bit more Google and stuff like that. Even Nvidia for me has been looking better. Now I looked today, PE of 36, so they've come off a lot. Balochistan says, "How are you? I'm well, as good as can be expected." Um, I always joke with my friends on Fridays and Saturdays, like, "Oh, I've had a tough week," but because I haven't worked for 5 years, I can't really say that I have a tough week anymore. Um, Coffee Chemist says, "American here. Hello, American. Just curious what the sentiment towards President Donald Trump tariffs is in Canada." Yeah, we don't like it. It's united Canada in a way that our politicians could not previously, in dislike of uh, let's say Republicans and in general, and Donald Trump in particular. I don't think anybody's spray painting Teslas in Canada, but I don't think we like Elon either. I never have. I always thought he was a loose cannon. That was before he started doing even weirder things. Texas Repo says Ford caved. I don't know what Ford did. Ford is talking tough. He caved like Trudeau. The Ontario Premier. Yeah, it sounds like he backed away from some stuff, but so did Trump. Like it's all a bunch of bluster. Um, but yeah, like honestly, the more of the stuff you pile on, like it just gets worse. Nobody wins a trade war, right? Like we all lose out. Um, the thing was when Trump put on the very initial 25%, economically, probably the best thing for Canada would be to have done nothing. With the counter tariffs, that can put us into a recession because tariffs actually mostly hurt the country that's putting them on. So if we had just kind of said, okay, fine, it would have hurt Americans the most because there's kind of three things that can happen with the so okay. I'm sure everybody knows this by now, but the tariffs are paid by the importer. They're paid by the US company importing the goods in, right? So they can do one of a couple of things. One, they can say to the exporter in Canada, they can say, hey, listen, we're paying 25% here. You're going to have to give us a discount. They probably won't give them a 25% discount, but in that case, the Canadian company bears some of it, definitely not all of it. And then the importer in the US can either eat some of the 25% tariffs and or pass it all to the consumer in the US, or a combination. But it's definitely going to cause consumers in the US to pay more, at least some, if not the whole 25%. Or alternately, and this is a much longer thing, is that they stop buying stuff from Canada, which is one of the results Trump is hoping for, and they start buying American. But the reason why they weren't getting the goods from the US to begin with is because those are more expensive than Canada or China or wherever the goods are coming from. So again, that will be passed on to the consumer. So tariffs are vast majority of the time inflationary. Um, and if Canadians just let the US do their 25% thing and just say, okay, they're sort of hurting themselves, it would have been fine. But with the counters, those are now hurting Canadians, causing Canadian inflation, and they could put us into a recession in 2025. Then again, without the counter tariffs, there wouldn't be a stopping to the original US tariffs, and there wouldn't be any negotiation if Canada just kind of said, okay, sure, have your consumers pay them. So the fact that Ford backed away from some stuff and Trump is like you can't really believe the stuff he says. He waffles back and forth, and I think he forgets stuff, and it's just a little ridiculous. But um, so the fact that Fort Caved is actually okay, in my mind, Trump either delays or forgets about stuff and then amps other stuff up. He just makes stuff up as he goes along. I don't think he's really doing anything according to any advisors or anything. So the harder we fight, the worse it is, right? So I'm okay with Ford caving. Rand says herd economy structurally good. Um, we're not booming. We have a fairly high unemployment rate. Thankfully, the inflation came off. It's not a booming economy. It's okay. Definitely not recessionary. If the tariffs persist and they're anywhere near the 25% level or higher, like it'll be a lot worse on Canada because we're smaller by a factor of 10 than the US. The tariff war, if it persists, will still damage the US economy as well, but just lower the GDP, while ours will end up being, sorry, it will lower the growth of the GDP in the US. In Canada, it will actually make the economy contract, meaning GDP is decreasing. Texas Repo says Ford is talking tough. He caved like Trudeau. I like this. This isn't. This isn't. I'm trying to avoid saying dick measuring contest. Um, like these are world leaders. You need diplomacy. Like it's not that I'm the toughest guy at the bar. It's what is the best for my constituents. Uh, I don't know about caving. Like we want things to be back where goods are flowing across the border and we're not booing each other's national anthems. I don't know, but I mean, again, anecdotally from some TikTok videos, like some Americans are already feeling it. So Stange says dump the Donald. Well, we got him for 4 years. After just a couple of months, every time I see him, I'm like, 4 more years of this. Anyways, Ryan says, was thinking Google to Canadian dollar is down a lot. Was thinking CDR instead. What's your opinion? So I did a video about CDRs. There's a whole bunch of them out there. CIBC kind of started it. And BMO put out a bunch now. I think they were at 15, and I think they're putting out more. So I don't own any CDRs, but the way I understand it, CDRs have a currency hedge that once you buy it, it doesn't matter whether like what the currencies do compared to each other. They hedge that out, and actually for that they're charging up to 0.6%. So they're actually paying themselves fairly nicely. Like ETFs usually just charge 0.2 annually. They're charging you sort of behind the scenes and paying themselves 0.6%. So that's why they put them out. Otherwise, they don't have other fees. So the fluctuations after you buy it have um, um, have been eliminated. Like you don't benefit or lose depending on what the currency does. I think though, and I didn't really get an answer to it anywhere, is that the weak dollar still makes a difference. Like you still get less because of the weak dollar. It's just that once you have the CDRs, the fluctuations after that don't matter. That was sort of my understanding. I could be wrong. They weren't very specific about it anywhere, and I'm just like, well, I do have the US versions of Google, like the originals on NASDAQ, and Microsoft and Amazon, but that was back when I had American dollars. I have some sort of a weird aversion to paying that 1.5-2% currency conversion. So if I don't have American dollars, I don't seem to buy American stocks. But yeah, the CDR. The thing is, what do you think the US dollar is going to do compared to the Canadian from here on out? Right? Like we're still lowering interest rates, so the Canadian dollar is still going to get weaker, is sort of what I'm thinking. But in the long run, the US dollar will get weaker, or like even medium run. But with the Canadian dollar being weak today, I believe, and please double check that you get less of it. Like there has to be some sort of a penalty, but then they hedge out the fluctuations after. Lynn says, I live in the US and despise Trump. I mean, the elections are won by a couple of percentage points, right? So there's a good percentage of people that didn't vote for him, and some number of those don't like him. But I think the rest of the world is not pleased with the U.S. just politically, like flipping sides and now sort of standing with the Russians against Ukraine. Like that seemed like a tough one. And I think he just kind of did that off the cuff. Like I don't think there were any advisors that said, "Hey, talk crap to him." That was terrible. That's like honestly, like Obama. My goodness, what a diplomat. How such a nice man. And you know, he gave the U.S. a good name in the world, and then it sort of got worse after that, with Trump number one. The fact that the U.S. voted for him a second time, I have no words for. Anyways, I'm trying not to be too political, but Stan says everyone should turn in their Tesla. Well, I don't think it's that easy to get rid of them. Lynn is in Tennessee. James says, which one would you choose between TELUS and Bell? Bell offers better dividend and discount on DRIP. TELUS is not that bad. What's your opinion? Yeah, James, I own both. Which one do I own more of? Let's take a quick look. That's not what I wanted. So Bell, I got 50 grand, and TELUS, I have 112. So I have twice as much TELUS as Bell. Bell is an opportunity. It's a turnaround story if they manage to turn it around. TELUS is the better of the two companies financially from an investing point of view. Bell has a lot of debt, and they bought themselves more customers, which could turn out to be magical and amazing in hindsight if it works out. The safe thing would have been to pay off some of their debt. In order to grow out of their debt, they bought more customers. They're gonna cause more debt, and time will tell if they will actually turn it around. TELUS is financially the sounder of the two. But I think just like the telcos and the Canadian banks for that matter, they're having trouble. All of them are having trouble growing. And it's tough to increase your share price if you're not increasing your sales and your profits, right? So TELUS is better. It's not as good of an opportunity, I guess, as Bell. But Bell, they're not going to go bankrupt, but they could also get bought out, on 70 cents on a dollar kind of thing. So that's my thinking. And I don't own any other telcos. So Coffee Chemist says, I hear so many things from different sources. It's hard to flesh out the good and bad media. However, I've heard Canada has over 2 100% tariffs on many exports into the U.S. I think there is existing tariffs. There is something, and I mean I haven't read it. The most recent North American Free Trade Agreement that Trump signed, and then a few years later says that it's the worst deal ever. It's like, well, you did it. So I don't know what's in there as far as tariffs, but like you have some sort of a status quo, right? Trade is flowing. And by the way, I know the media is making it sound like it, but international trade is increasing. Even during Trump's first term, trade between Canada and the US had been increasing. The media is making it sound like we're all isolated and nothing's moving. It's just that what Trump is doing is he's slowing down the increases in international trade. So just let's be clear, it's not that like we're all isolationist and nothing is coming across the borders. It's just that it's not increasing in volume as quickly as it did, let's say, during Biden's time. Okay. So I don't know about 2000%, like the whole milk and farmers thing, like ours in Canada, I'm a little bit outside of my knowledge area, but like we have farmers boards and stuff like that sort of regulate things a little bit, while in the US farmers don't make enough money because it's kind of the wild west, and they're sort of competing on price because like eggs are commodities, right? Milk is a commodity. So maybe as a result things are being tariffed. I don't know. So I don't know, coffee chemist, about the 2,200% tariffs. It could be. I don't know what it is. But all I know is Trump started adding to it, and then Canada started adding to it. And to me, like, it sounds like this should all be spelled out in the free trade agreement or in the trade agreement. So Trump theoretically would have been against the agreement, and then of course Canada and Mexico piled on. Okay, yeah, there's Ethan. How would a recession and the market move in relation to one another? So the market tries to predict all this stuff, right? We don't have an official recession until there's like an academic body in the US and in Canada, I can't remember the name, on either side of the border, that says we had just been in a recession. So you could have a negative GDP growth for 2 quarters. That's the technical definition of a recession. But if you have near full employment, nobody's losing their houses, nobody's losing their cars, that's not a recession, even if you have negative GDP growth, because nobody feels it. So then those academic bodies are just going to say, we're fine. But after 6 months of negative GDP growth, where people, what's the expression? If my neighbor loses his job, it's a recession. If I lose my job, it's a depression, or something like that. So only after people start feeling it would somebody say, okay, we've got a recession. So having said that, the markets are always looking ahead, guessing, give or take. So the recessions could still be deepening, and the market is already going up because they're looking ahead, and they say, well, the recessions are usually just this long, and so we're thinking we're going to come out of it, and people start buying as a result, preemptively, right? The 6 months ahead. So generally the market senses the recession, which is sort of what it's doing now. It could be wrong, in which case the market will recover a lot quicker, and of course the economy won't do anything bad. If the recession happens, the market will go down some more on the confirmation, but then as the recession is still deepening, the market is already going to take off because we know that the recessions don't last that long. You'll have interest rate cuts by the central bank to goose the economy a little bit, and that will be sort of the end of it, and off we go. So yeah, timing wise, the market predates the recession. You're not going to get a 1930s depression these days because the government and the central banks fiddle with the economy. So central banks would cut interest rates to get people to spend more, buy more, invest more. The government would go into even more debt to stimulate the economy. So like we're not going to get into a depression. Not that you asked. John says, thoughts on Chipotle? Let's take a quick look. CMG, thank you for the ticker and the on New York. Ticker and the name. Well, it's definitely come off. Like for me, a PE of 44, which is what it's showing, that's a little bit rich for a restaurant. So like I wouldn't be a buyer. I would need it to come off some more. Also with a PE like that, it could go down to 45, it could go down to 40, and the PE is still going to be pretty high. So you don't really know where the bottom is. While like if the PE was 12, I would say if it gets into single digits, I would be thinking it's sort of near the bottom, right? But with the PE this high, you can't tell. I mean, back in July, it looks like it hit a bottom at $48. So let's see if it bounces off of 48. It's at 50 now. It could bounce off of there. If it breaks through, putting my technical analysis hat on, if it breaks through that, then it could keep going down some more. It's had a really big run up for the last 5 years, and only recently has it sort of come off. Sales are increasing year over year for sure. Solidly profitable and increasing profits. So that's the E in the PE ratio, is the earnings. So that looks good. Quarter to quarter, if you squint a little, you'll get an upward trend in sales for the last 4 quarters. Sales actually going down the last 3 quarters. So that's net income profits going down the last 3 quarters. So maybe that's caused the trend downwards. Not a bad company for sure. Just I think they're still overpriced. People get excited about stuff and they pile in. Name brand, obviously, so an economic moat. According to Morningstar, fair value is $46, so they're seeing them as overpriced. Other analysts are saying $67 the fair market value. Interesting. Okay. So yeah, like for me as a value investor, they're a little bit too pricey. Like I would need them to get, like for a restaurant, like I would really need them to get into the 20s, which would mean that they'd have to drop down to $25 and keep the same earnings, which is unlikely. Yeah, it's just like there's a lot of future profits priced in. So Texas says turnabout is fair play on tariffs. To me, you know, it's not good for your economy. Maybe it's good for your ego. Maybe it's for Canada, it's a negotiation tactic as well. It's like, hey, we'll slap these on, and then we'll say, okay, we'll call it even. Because with Trump starting it with it, he's basically pulling an ace out of his sleeve, depending on the strength of the U.S. consumer to basically get what he wants. The whole fentanyl thing and immigration, like that's got nothing to do with Canada. Like that's ridiculous. So I don't know whether that's just or whether he just wants to be given concessions so he can say, yeah, Big Donnie. Whether it's just feeding his ego. I have no idea what's behind that man's thinking. So it while it could get the tariffs taken off by putting in counter tariffs, it could also escalate it, which actually it seems to be doing, and it harms everyone. So, am I adding to any of my positions? I'll tell you, John. By total coincidence, I I was transferring my RSP from Qtrade into Wealthsimple to take advantage of that 2% matching that they have. And so for about 3 weeks, I was entirely in cash because I had to sell the mutual funds. I'm going to do this weekend, I'm going to do a YouTube video about it. So I had mutual funds, which Qtrade supports, Wealthsimple does not. So I had to go to cash in my RSP and then transfer over the cash. So on Friday, I went shopping. Could have gone shopping Monday, would have been slightly better result. But I bought myself 7 ETFs, one following the TSX 60, one following the S&P 500, one following developed markets or EFI, so Europe, Australasia, Far East, and then fourth one with emerging markets. This is very much the same as what I have in my TFSA already. So I got that into my RSP. But for little extra fun, I added 2 extra ETFs. One was US small caps, Russell 2000 index, basically. So that is going to have higher volatility, but small caps outperform over the long run, especially value small caps. I couldn't find anything that was value specifically. And the other fun one was TD Global Tech Leaders, TEC. So that one's kind of the usual suspects from tech. I didn't want to do NASDAQ 100, so I did one that is specifically technology, and I'm going to hold it for 30 years. And I think it'll perform. And then the last ETF for less fun was a world bond ETF. About 5% of the amount that went in. That is for 2 reasons. If the stocks continue to take a beating, the stock ETFs continue to take a beating, I'll sell that, make myself feel better, and buy the cheap stock ETFs. And the other thing is, I'm 52. At 60, I'm going to begin pulling money. I'll flip them to RIFs probably, but I'll start pulling money out of my RSPs. So in 8 years, and because that is getting to be short enough time, I wanted to make sure that I had something that would work differently than the stock ETFs. So I got myself a bond. And true to form, everything is down since Friday, with the exception of the bond market. But of course, bonds will underperform over a long period of time. So that's one thing that I added to. And then the other thing is I sell put options in order to get more stocks. And what I have out right now, so for the March 21 expiry, so in a week and a half, I have Northland Power, Bank of Nova Scotia, Sun Life, and Mullen, which is a trucking company, and Whitecap Resources, oil company. And then expiring in April, I've got Nutrien, Toronto Dominion, and Cenovus. So if the prices drop below, and I'm not going to list off all the numbers, below certain prices, then I'll get more, usually $5,000 worth more. So that's sort of what I'm adding to. My biggest holdings by current market value, I'm giving you all of this stuff. Manulife is my biggest single holding, followed by Go Easy, GSY. And then there's 4 mutual funds, and then emerging markets. Vanguard Emerging Markets ETF, VEE, is my, 7th biggest holding. Then Royal Bank, Bank of Nova Scotia. So the reason I mention those is theoretically because I own them, I should like them, and theoretically, again, be willing to add to them, which I have. Phew, okay, I hope that was interesting. Ethan says, thank you. What does your crystal ball say? I've made jokes about crystal balls being cloudy. Say for a downturn, roughly 9% now, do you think we'll get to minus 20? Yeah, I mean, all I can tell you is in 5 years, the stock markets are going to be higher. In the short run, like they could keep this going and just hurt the economy and cause a recession, and the markets are going to keep pricing that in more and more. Or tomorrow they could shake hands. Trump will walk away and be able to say that he negotiated the best trade deal ever. Who knows? Who knows? Like it's down some. It's sort of priced in a bit of a recession. It priced in some damage to the economy. It could easily, it would not shock me if we had a bear market, which is the minus 20% you mentioned. I'm hoping it'll go down a little bit more, maybe at worst, and sort of stabilize. Like the market hasn't gotten any more news because they just watched Trump try to sell Tesla for some reason, Tesla vehicles, and hasn't been threatening anybody, at least not that I'm aware. Of course, I get all my news from the liberal media, so. So short answer is I don't know. It could do anything. Like I'm hoping it won't get to minus 20, but it wouldn't shock me if it did. Happy Camper says, how much do you worry about diversification in your portfolio? Wow, great question. Generally, I don't worry, but diversification is important. Also, the only free lunch in investing. I have a lot of Canadian stuff because the dividends that they kick off are tax efficient. So I already have geographic diversification. Those are financials and life cos and energy companies of all sorts for the most part. So that's about half my portfolios, these individual Canadian dividend payers. I do have American stocks as well. Those I went for growth mostly. And that's about 10% of the portfolio. And then the remainder is ETFs and mutual funds. Some Canadian, some US, but I try to hit the rest of the world, and especially emerging markets, because that's where I think there's going to be That's where the growth is going to be because of the growing population. I'm a big demographics person. So I think I am diversified um, the world over. If you look at it in terms of market cap, the U.S. is about. You're welcome, John. The U.S. is about 60. I haven't looked recently. 60, maybe even 65% of the market capitalization. So I'm underweighted the US because they're quite expensive. I do have US stuff, individual stocks. Like I said, I just bought an ETF following the S&P 500 and then Russell 2000 as well. And the tech ETF is still a lot of US in there. So there's some overlap with the S&P 500 also. So like I don't want to leave the US out entirely because they could continue grinding upwards. They've been overpriced for a long time. Now, of course, they've come off some. So the pause that refreshes, as they say. So that could very well be um, still a source of growth. So so happy camper. I'm not sure if I'm helping, but that was sort of how I set up my portfolio. Um, very easily just do 4 ETFs. You could do an all-in-one ETF. You could even do an ETF that's covers the whole world and it has some bonds in there. So you've got a built-in balanced. I think there's VBAL, Victor, Bravo, Alpha Lima is the ticker. I believe. I can take a quick look actually. I don't have to just believe. I can look. VBAL, Vanguard Balanced ETF. So that one is the whole world plus. Not that I'm advocating it. I don't have it. So the whole world, and you never have to do anything again. So that's kind of built-in diversification. Okay, I think I answered that. If not, please ask me again. James Judith says, what is your thought about high income ETF? I bought small amounts of HHIS in my TFSA. HHIS. Okay. 28% yield. Wow, that sounds. Yeah, so that's a covered call strategy. That thing has no. Okay. That thing has no history. It came out in January. Like, that's not, and it's already lost a heck of a lot of money. Yeah, I don't like covered calls, which this seems to be like the 8% of it is like a Tesla enhanced high income. So they use options on Tesla, which is highly volatile, so it pays off real nice premiums. And so they use that as a part of it. I don't like them because over the long run they underperform just like a regular ETF that has the same composition without the covered call overlay. So really quickly, yeah, it does give a nice annual percentage and it pays it monthly. So the thing is over a 10-year period, markets go up. Anything with a covered call, this is what a covered call is. Stock price is here. The ETF owns stocks or it owns other ETFs that own stocks. Stock price is here. They sell a promise to sell the stock at this value. That gets them a premium right up front. So if the stock stays down here, you got that premium as a bonus. So in a flat market or a down market, you're actually better off and you're arguably removing some of the risk because you're getting that extra premium. Okay. But if the stocks go up, which over the long run they do, you miss out on this part. Okay. So like this thing doesn't have any share price appreciation. It just kicks you off that 28%, which is Let's see how long it can keep doing it. So if you can say there's going to be a down market or a flat market, this would be the thing. But of course, now you're timing the market, which we're really bad at as humans. Which is, by the way, as soon as I have money, I put it in. I mentioned earlier, I bought my whole RSP's worth on, which is close to $500,000. Um, I bought it all on Friday. The money arrived on Thursday. I bought it on Friday. It's like now I'm gonna sit here and watch the market, and it's like, okay, it's going up, it's going up. Okay, should I buy? Should I buy? Or just a fake? Um, so yeah, like generally, as soon as the money comes in, through pure luck, I missed the whole in my RSP, which is like 10% of my invested amount. Um, I missed out on the whole downturn for 3 weeks because the money was in cash and was being transferred over to Wealthsimple. But as soon as it arrived, like I'm putting the money in. Like I'm not gonna sit on it and it's like, okay, today it went up. Damn it, it went up today. Like I'm not gonna do that to myself. Like I'm down 2%, like whoop-de-doo. If I'm down 10%, like I said, I'm not gonna start withdrawing it until 10 years or 8 years from now. Where was I? So yeah, you can't time the market. So over a 10-year period, if you compare like a NASDAQ 100 ETF and a NASDAQ 100 ETF with a covered call overlay, over a 10-year period, the one with the covered call overlay is going to be short annually by 1 to 2%. Okay, I'm sure you can find ones that even over a 10-year period still beat the non-covered call version, but the ones that I looked at don't, and it makes sense because they miss out on the upside. Okay, timing the market is not gonna help. If you bought it recently, like you lost money, but that the cash flow certainly helped. The other thing is, if in order for you to stay invested, you want to get that cash flow. Like dividends help people stay invested because when the market's going down, they're like, well, at least I'm getting the cash flow, at least I'm getting the dividends. If that's what keeps you invested and you're aware that there's likely 1 or 2% per year deficit, and you know about it, but you like the cash flow, or you hate digging into the premium and selling a few shares here and there, then by all means do HHIS. What is it? Harvest Diversified High Income. I over a 10-year period, these things underperform, but they kick off a nice cash flow, and if that makes you feel good, then by all means. Hey Gaia, hello. Are you worried about 15% when eventually selling US stocks or ETFs? So I think Gaia, you're referring to the 15% withholding, but that's on the dividends. So that happens if those things pay dividends along the way. So short answer is no. The 15% withholding doesn't happen in an RRSP. In my TFSA, the 15% is going to be on the 1% dividend yield that like the S&P 500 pays, and the others I don't think really pay much of anything. So in my TFSA, it's minuscule, the 15% of the 1%, and then pretty much of nothing, because like most of the stuff that I bought there, like the international ETFs are growth, and so they don't really pay a heck of a lot in dividends. And in my non-registered, I'll get dinged for it, but then you get a tax credit. You get a tax credit for it. So it doesn't happen there. But again, it's on the dividends. It's not on the capital gains, which you're sort of suggesting with the selling of the US. It happens as soon as you own the stock and it pays you a dividend, they grab 15%. In an RSP, it's avoidable, but it has to be US traded ETF or US traded stock. It cannot be like VFV, which is the S&P 500, but it's trading on the TSX. That will still ding you in an RSP. Everything in TFSA will have the 15% withholding, and you don't get it back. So I hope that helps. Happy Camper says, for your dividend paying stocks, do you do any dripping or just collect cash and buy what you want when you want? Yeah, good question. And I actually neglected, I'm sure that person isn't on anymore, asking about Bell versus TELUS. And I think they said that Bell had a better drip. So there's companies. Okay, so two things. One, you can set up a DRIP, which is dividend reinvestment plan. You can set it up with your brokerage. I've got that on a couple of things. You just check either for an account or for an individual stock or whatever. When it pays a dividend, it automatically gets reinvested. It buys you more shares. It's easy with mutual funds where you can have partial shares for sure. ETFs and stocks, if they have partial shares, then you can do that as well. And then some companies have it, and I haven't explored this for a reason I'll mention, that if you set up a DRIP through them, with them, I'm not quite sure whether your brokerage is involved or exactly how that works, but they give you a 2% discount on additional shares that you get through a DRIP. The 2% seems to be kind of the standard thing that all the companies that offer this use. To me, that's not really significant. So to answer Happy Camper's question, I generally don't have that turned on for individual stocks, which I'm using for my main dividends. I do have it for mutual funds. But the reason I don't is because that's what I buy my groceries with. And then whenever I accumulate a couple of bucks, like if there's a trading commission like in Q-Trade, I make sure that it's at least $5,000. If it's, so like right now I got a couple of $100 US, which is just sitting there because I'm waiting for it to accumulate. And then I'll buy a stock myself. It gives me flexibility, and it lets me make a choice because I can buy whatever is cheap or I like at the time, or I can, like if I have a margin account, it's paying off the margin debt automatically rather than reinvesting itself. So that way I have the control and I can buy whatever is cheap or what I like. The 2% bonus to me is not enough to make me buy that same, because the reason they give you the 2% bonus is so you drive the stock price up, right? By buying more shares. That to me is not a sufficient incentive to buy something that's maybe too expensive. Like as an example, just because I'm up to date on the questions. I'm up to date on the questions, aren't I? Like I always look at the Canadian banks as kind of five people running one behind the other. Right now, Royal Bank is at the front. CIBC is kind of second. They've been the best performers, and they're also the most expensive. So if I get a Royal Bank dividend, I prefer not to buy Royal Bank stock. At the back is arguably TD or BMO, with Bank of Nova Scotia somewhere in the middle. So I'd prefer to direct those dividends towards BMO or TD, which are at least on a PE level are cheaper. So that's why I don't do dripping. If I need to pay bills, that's one, and then I can buy whatever I like at the time. Ethan says, you mentioned Whitecap. I was looking at adding because they're down. Is their dividend safe? CP. Sorry, I'm a little distracted. One, looking at the dog who's snoozing because I took her to the dog park. And two, I am looking for a sock. Excuse me. Not something everybody needed to know. So yield of 8.5%. Wow. So they fell because they're doing they're yeah, Varen. Yeah, they're basically doing a deal with Varen. I'm not quite. I haven't read into it. I don't have enough Whitecap to be that interested. I do own it though. So whatever they're kind of going to be valued at, it looked like it was going to be less than what they were previously. I don't think it'll change the operations. Like even the payout ratio is 53%, so roughly half of their profits are going to paying the dividend, and cash flow I'm sure is going to be even better. Dividend is 73 cents and their cash flow is $2.78. So it's 4 times, which even 3 times I'm usually happy with. So I don't think the dividend's going to get cut. The dividend is high because of the I don't think it's an acquisition. I think it's just a merger. The last I looked. Eaglefly 18 says, I think -20 is very possible. It wouldn't be my base case. It all really depends, and it's completely out of our hands. And guessing at it, you can sit on cash however long you want. Don't forget, when you're kind of timing the market with stuff like this, there's tons of volatility. It could be the next tweet or the next press conference, and then you'll make a decision on it, and then Trump says, "Oh, psych." So I wouldn't make major decisions based on that kind of stuff anyway. The thing is, it's like usually these things are gonna last a short period of time, or it's not gonna be minus, or it's not gonna be 25%, right? I'm hoping that eventually somebody will say, "Hey guys, this is stupid. It's hurting both of us." What's the expression? Cutting off your nose to spite your face. So I'm hoping that they will, cooler heads will prevail, or whatever other cliches, and they'll stop acting like schoolyard bullies. So -20 is definitely possible. The longer the tariffs stay on, and or if it gets worse, the markets will begin to start pricing more of it in, and like we're down -10 or whatever, depending on which index you're looking at. Another -10 could absolutely happen. It would not shock me. I'm just not, maybe wishful thinking, but that's not my base case. So Eaglefly, yeah, very, very possible. Muhammad Ansari says, hey, Muhammad, how to plan and rebalance for recession? I can't remember who said the quote, and I'm just going to paraphrase the quote, but more money has been lost preparing and trying to avoid recessions than through actual recessions. So there's this, honestly, stop trying to time the market. All 9 of you that are showing us being on right now, you're not going to be able to do it. Like I remember a coworker, I've told this story before, a coworker who just before the first time Trump got elected, just before the election, He sold everything, went to gold. His portfolio was literally $2,000. Okay, so like it wasn't a huge thing. The hours I spent him uh, put it together, and then he just liquidated it all and just went to gold. And of course, the stock market went up after Trump got elected because stock markets like certainty. And now the recession, no, not recession, now the election was decided, and the market felt better about it. Republicans aren't really the party of business. Like they just deregulate and they cut taxes for corporations. But actually, the stock markets do slightly better under Democrats. The last time I heard. Um, anyway, I went off topic there. So, like, if you actually want to just shift your whole portfolio, buy uh, like consumer goods that are unavoidable. So Johnson and Johnson, groceries, that kind of stuff. Um, don't buy, avoid consumer discretionaries. Financials tend to do poorly in a recession. Um, uh, Pretty much all materials. Like you just need less oil, you need and energy, you need less copper because like everything just slows down. But like to me, I have 60 different stocks and like 20, maybe 25 now ETFs and mutual funds. Like I'm not gonna reshuffle my whole portfolio on a hunch, first of all, and knowing that in 6 months, a year, it's going to be back upwards, and not like he could do it tomorrow. Okay, just too much effort, too much capital gains taxes to pay all at once. Just not what I'm going to do. If you have a very manageable portfolio, if you have a couple of ETFs and you want to shift stuff around, you don't have that much in capital gains, you're still going to time it badly and you're going to pick the wrong sectors for a lot of the time. So I wouldn't suggest it. Just, especially if you don't find it fascinating, if you just want to make money, buy one ETF, three, four ETFs if you want to do it geographically, and then automatically put more money into each one on a monthly basis out of your paycheck and just watch it grow. What my plan is, by the way, I'm not going to rebalance, but if we do hit that minus 20, I kind of have a rule that at that point, once it's happened, right? So here's the thing: there's difference between trying to predict it and making moves now to benefit or at least minimize losses from a recession and a bear market versus waiting, let the bear market happen. Don't cry over your portfolio losing. Well, mine's a little bit more conservative, so it might only lose 10, maybe 15%. As long as it keeps paying the dividends, I don't have to go to work, which is my main goal for my portfolio. I'm not going to beat Warren Buffett by the time I'm his age. So, yeah. So what my thing is if it is a bear market minus 20, I will I will start borrowing to invest. So margin account, HELOC, home equity line of credit on my Palace. Um, at that point, yeah, I can go to minus 30, but like that's not likely. But the minus 20 can certainly happen. So that's what would be my plan for a recession and more accurately a bear market. A recession isn't going to hurt me personally because I don't work. Um, but that's what I do. That's what I do with a bear market, but only after it happens, right? I don't try to guess and say, I think there's going to be a bear market and a deep recession. Like it would be completely artificially manufactured Like, the thing is, Trump knows he can't run for another re-election, and so he can basically do whatever he wants without any consequences, and that sort of makes him dangerous, because he could just persist with it and just like, yeah, I don't care. But hopefully there's some backroom group of Republicans that would say, okay, we need to get him out of here, or he's, we're not going to be in power for the next 50 years. Happy Camper says, do you have a preferred software to track your entire portfolio? Yeah, good question. So I have 3 different brokerages, almost had 4, but I decided to go to Wealthsimple instead of Questrade. So I had Q Trade first, then I got Wealthsimple, and then I got Interactive Brokers, and then I transferred over time more stuff to Wealthsimple. Interactive Brokers I use for options and for their very cheap margin. Wealthsimple I use for originally Canadian. Now I transferred US stuff in there as well, but because I have enough money with them, they basically don't charge me that 1.5% each time I sell a US stock. Only when I pull the money out, then it gets converted from US to Canadian, and then they charge the 1.5%, and it could be 1 or even a 0 if I convert enough money at a time, which I won't convert that much. But for one source of truth, I use Quicken, a very, very old PC version of Quicken. I updated it to the 2010 version. 2010 version because the 2004, I think, that I had prior to that would not work on Windows 10, which I installed on my new computer, which I bought used and just stuck a solid state drive into. So I use Quicken was the short answer. James says, your thoughts about REITs. I did a video recently. Checking RioCan and Smart Center, it seems kind of cheap, and Dividend is decent, around 7%, or about to buy bank stocks for growth and dividends. I don't have any REITs. It wasn't really conscious. They just pay the dividend. You're not really going to get much growth, at least in most of them. They have come off. The high interest rates are probably finally hurting them. It depends how they structure their debt. So RioCan, let's take a quick look. A lot of REITs, like with real estate, you're borrowing, right? So so they cut their dividend 4 or 5 years ago. Interesting. They generally have to pay out about 90% of their profits. They're showing 70% as a payout ratio. I'm not sure. If they want to get tax preferential treatment, then they have to pay out 90% on both sides of the border. Annual dividends $1.16, and then the cash flow is $1.56. So they're paying pretty much everything out. And yeah, like they sort of stayed flat, right? Like, or if anything, since 2022, they've been heading downwards. I'm assuming because of the higher interest rates. They're not bad. They're just going to pay you that 6% yield, and that's sort of it. Anyway, so yeah, the banks will go up over time. Some sooner than others, like Bank of Nova Scotia's underperformed. Obviously, TD's had a roller coaster ride because of the whole U.S. debacle. Smart Center, real quick. Smart real estate. So SRU, I'm hoping. Smart Centers real estate. Okay. Well, they're not cheap. Their dividend is 7.3%. Their payout ratio is 139. What's the cash flow? They're paying $1.85, and their cash flow is $2.35. So they're paying out most of their cash flow. With REITs, it's probably a little bit different, but generally I prefer the cash flow to be 3 times that of the dividend, and the payout ratio. It's payout ratios really only apply to financials. Pretty much anything else. Look at operating income. Cash flow is a good one. Free cash flow is even a better one. So yeah, like since September, they've sort of trended downwards, if anything, or flat maybe. Yeah, but yeah, you get a nice dividend, right? Tax efficient, I'm assuming. Anyway, so yeah, like I'm more of a bank stock guy. The last REIT I had was Granite, and there was supposed to be some sort of a withholding, tax withholding, and nobody could tell me what it was going to be, on what it was going to be, and I just sold it. Like I didn't want to possibly have to do a U.S. tax return because I had just sold my last U.S. house and was happy not to have to do a U.S. tax return. So that's why I sold Granite. And I looked a couple of years later and it had gone down a lot. So I'm like, hey, luck was on your side for once. Mohammed says, I'm relatively new to investing. I'm aware, still practicing to stay calm. Yeah, you sort of get used to it. Like, if you want safety, then you're looking at term deposits, right? And then you're getting 3-4%. If you want, like we had the last 2 years, 20+%, you'll have the occasional 2022, and then you'll have the volatility that we have today. But if you space it out over time, you don't see it. It's just you have to have that time and you have to have that vision. But a friend of mine from nowhere came and said, move everything to GIC. I was like, no, everyone says stay put and keep investing. Yeah, like I don't do GICs. I don't hold cash. As I mentioned earlier, pretty much as soon as the money transferred over, I just like within 10 minutes, I spent $500,000 buying ETFs on Wealthsimple. I've never done GICs. I'm holding cash because I already know I'm going to have a $40,000 tax bill in my personal. My corporate got a nice refund, but I'm gonna owe. I definitely gonna owe money for the personal. So I'm holding cash for that. Otherwise, I don't even have an emergency fund. That's not really what you're supposed to do. But between credit cards and HELOC, I know that like I don't know what kind of emergency I would have to have, but I'll get enough dividends to pay it off by the time the credit card is due. So I don't do cash. I don't know what GICs pay these days. Like my Wealthsimple high interest savings account, I think pays 3%, better than inflation. But I know over time stocks will outperform that. So especially when it's down, buy more. Buy more when it's down 10%. Like unless you have unlimited money, don't make a special purchase when it's down 3%. But if it's down 10%, if it's down 15%, buy. And then buy regularly as well. As you make the money, automate it if you don't trust yourself to transfer the money over and buy something. So definitely keep investing when you're in the accumulation phase. Ethan says, Jack Bogle says, don't do something, just stand there. Yeah, absolutely. Absolutely. We investors are usually our own worst enemies. We pile in after the stock has gone up because we assume it's just going to keep going up because that's how things work, which they don't. So they buy at the top and then it crashes and they they sell at the bottom. Um, like if you just buy the index ETF, whether it's the TSX or the S&P 500 or whatever, if you look, people actually underperform that because they jump in at the wrong time, they get out at the wrong time. Just keep buying. I you know it's going to go back up. Like I can't tell you what the market will do tomorrow. I can't tell you. I'll start taking positive bets on a year out that it's going to be higher. But over a 1 year, I'm making the numbers up, but you'll see the trend. Okay, in 1 year. So okay, next day 50-50, up or down. After a year, 60-40. 3 years, 70-30. 5 years, 80-20. And over like a 10-year period, with the exception of the NASDAQ after the dot-com crash and Japan, since the 90s, they had a lost 30 years basically. There's basically no 10-year period, let alone a 15-year period when the markets are negative. Okay? So it depends on your time horizon. Now, if you say, hey, I'm going on a vacation, and I'm going off on a tangent, so I hope this is interesting. If you're going on a vacation in 6 months, don't put the money for the vacation into the stock market, because you could get lucky and it'll be higher, and then you'll be like, hey, best use of the money, right? Like the money that I need for my taxes in what, 6 months? Say 6 weeks. I wish it was 6 months. 6 weeks. It's been getting 3% in the Wealthsimple HISA. But if you're saving for your kids to go to college and they're 5, then that should be in stocks. Your friend Mohammed trying to time the market. Sure, it could get a lot worse. It absolutely could. Trump doesn't have anything to lose. He might want to be the remembered savior of the United States and solve the problem that he himself created. Who knows? Tommy, okay. Tommy says, I sold mostly out of the US last year and bought the DAX. Okay, and UK stocks. Best start to a year ever. Europe's had, yeah, so my EFI, so Europe, Australasia, Far East, has done quite well. Actually, so have emerging markets. Could the US finally, but I mean, it's all self-inflicted. Like, I think it was JP Morgan or Goldman Sachs said that over the next 10 years, the US is going to average 3% a year, right? So like even my dividends on my TSX stuff will beat that. Doesn't mean that it'll be 3% every year. It could be 10% 1 year and then, minus 7. That's the next year. But maybe it's finally going to happen. The money left the U.S. stocks because they got tired of this crap, and they went to other developed nations. Europe's been a bit of a basket case up until now, but yeah, and like the emerging markets have done fairly well as well. So yeah, good stuff, Tommy. The thing is, do you stay in Europe now for the foreseeable future, for the next 10 years, or do you get out? What do you do? I've pulled some money out of the US some time ago, as well. ETFs mostly, and bought the emerging markets. And then I underweighted the US. But they could keep they could move past this, and yeah, there's going to be a trade deal. Trump's going to pat himself on the back, and the US market could take off, right? So Gaia says, Alesh, could you explain how you borrow against a HELOC and write off the borrowed amount? It's called the Smith maneuver. Yeah, so because we're up to date, I'll get into this. So first of all, borrowing to invest, you're writing off. So let me correct you, you're not writing off the borrowed amount, you're writing off the interest. So whatever tax bracket you're in, that's the discount you get on the interest. Okay, just to be clear. You're not writing off the borrowed amount, just the interest that your line of credit, home equity line of credit charges you. So if you're paying $500 in interest per month, and you're in a 30% tax bracket, you write off the 500, but you basically get $150 off your taxes with a 30% times the 500. Okay, so if you want to be able to write off the interest, it needs to be three things. Number one, you're borrowing to invest. Number two, it's a non-registered account. So investment properties are generally non-registered. And of course, brokerage accounts, you just set up a non-registered or cash account sometimes, just to be confusing. And then the third thing, which trips people up, is there has to be a cash flow or an expectation of cash flow. So be careful with that. Because if you buy gold and you get audited, they're going to disallow that. Okay? Because that will never have a dividend or some sort of cash flow. Investment property, no problem. Dividend paying stocks, no problem. If it's a stock that doesn't pay a dividend and they didn't have some sort of a news release that they say that they're going to pay a dividend, again, if you get audited, they could flag that. If they could directly trace, okay, borrowed, bought this stock doesn't pay a dividend, never paid a dividend, didn't say they'll pay a dividend. If you buy a property out in the boonies somewhere that's just going to be empty land for the next 20 years, that interest deduction could also be disallowed. If you can show them architectural plans that you're going to build a quadplex on that property reasonably soon, then it would probably be okay. I'm guessing or speculating on that. Now, Smith maneuver. Smith maneuver is made to sound really complicated, and it's really not. So you can ask for, or by default, you get, like I got a Royal Bank mortgage, and it had a home equity line of credit as a secondary. So I borrowed whatever, 200,000, and as I paid down the mortgage principal, the second part, the home equity line of credit, started getting an available balance. So, paid 1,000 a month, most of it interest. And then after the first one, I'm making this up, the HELOC had $200 in available credit. If I take that $200 and I invested, as mentioned previously, the interest on that loan is tax deductible. As long as I use it to borrow, it's got nothing to do with the house. Okay, you could borrow using an unsecured line of credit on your good name. But what they're basically, the Smith maneuver, they're saying, we can make your mortgage interest tax deductible. And that is very, very misleading, because what it is doing is you're paying off your mortgage and you're instead borrowing to arguably buy a second asset, right? House is one, now through borrowing and paying interest, you're buying a second asset, which is appreciating, again, arguably faster than the house. And you're able to deduct the interest. You're able to deduct the interest on that loan, but you're basically paying off your mortgage principal, and you're turning around and you're investing with that available money. They're charging you interest on that now, so you're paying interest on what's left of your mortgage, and you're paying interest on the HELOC. They basically, the banks like this because they keep you paying interest on it's always the full amount of the full borrowed amount, right? In my example, 200,000 is always what I'm going to be paying interest on as long as I keep pulling money out of the HELOC, um, and investing using that money. I'm always going to owe them 200,000. It's just the mortgage is going to get smaller and smaller, and the HELOC balance owing is going to get higher. So at the end, in 20 years, house is paid off, the mortgages, but you still owe money on it in a HELOC. I also know, I don't know if it's still being done or not, but I know that instead of getting a mortgage where you have to pay off interest and principal, you can just get a HELOC, get the whole borrowed balance on there, and pay pay the interest. And you could use that HELOC if you paid off some of the principal. You could use that HELOC the exact same way and never have a mortgage and never have to do a Smith maneuver. There's nothing complicated about it, but it's sort of being sold, and there's accountants who specialize in it and get certified in it. And I'm just like, okay, I didn't think it was that complex, but maybe. There was something also about capitalizing the interest, meaning you don't even have to pay the interest. The interest just gets added on to the loan. I would assume you'd have to have more balance available in order to do that. But generally, like if you have a HELOC on a house, you only have to pay the interest. You don't actually ever have to pay off the balance, which is the way the bank likes it, as long as you keep paying the interest. They want the interest, right? They don't want you to pay off the debt. So at the end, you have hopefully more than $200,000 worth of, in my example, worth of stock. You have a paid off house, and you have 200,000 in debt on the HELOC. And you've been paying interest on it all the way along as it went from 0 to 200,000 on the HELOC. So you got a tax deduction. The assets you bought hopefully were cash flowing, and we're paying you dividends that hopefully were more than the interest. From a tax point of view, if you're like me and you bought Canadian stocks, the dividends are taxed lightly because they're Canadian eligible dividends, and the interest is written off against salary. So from a tax perspective, you're also coming out ahead because the interest gets fully deducted while the dividends, if they're the right kind of dividends, are not taxed fully. Am I up to date still? Okay. So Guy, I hope I answered that. I haven't seen any new comments pop up. Sometime. Oh, here we go. Okay, they're still working. I've had a couple of sessions where, like for 10, 15 minutes, there wasn't any new comments coming in, and then all 20 of them jumped in all at the same time. And then there was another session where I actually said, okay, well, nobody else is interested. And just the comments weren't showing up. So I actually ended the session, and then somebody wrote me and said, hey, by the way, you weren't seeing our comments. So anyway, if you have comments, ask away. I'll regale you with the story of my life from a financial point of view if you're interested. Please ask unrelated questions to that. I'll stop and I'll answer your questions. But yeah, basically how I got to, and not to brag, but my net worth is like 6.1. It was 6.2 a month ago before the little correction. How I got to 6.1 million in net worth was I started investing really like second job out of university, so we're roughly at 23. Had a financial advisor, made mistakes, generally misunderstandings with fees and um, like 10 years later, there wasn't any appreciation. Um, and I'm just like, well, well, 6 or 7 years later I started investing probably 97. And then in 2004, when I needed the money to buy a house of my very own, um, not only that, the 50,000 that I put in was still 50,000, but also along the way I paid all sorts of fees. And then because I withdrew the money before the deferred sales charge expired, which it's not allowed anymore, but it used to be back then. If you didn't keep the money invested for 7 years, they would charge you decreasing penalties when you sold. So I still paid like a couple of percentage points on the money that they did give me. And the financial advisor said, "Oh, if I knew when you needed the money, I would have put you into front end," which means that instead of the penalty for early withdrawal, they just charge me, and I honestly don't know what they charge me, but it could have been 2% of the invested money, or it could have been up to 5% of the invested money. And that all went into the financial advisor's pocket, as did 5% when he sold me on a deferred sales charge mutual funds. So I learned about all of that. I started reading, and then in 2005 to 2007, I had a really bad job, which I should have quit. But it was 4 kilometers away, so I biked. And I thought this is great, except that I was working Saturdays as well, and just not doing what my manager wanted, apparently. So eventually I did quit the job, but by then I basically had, okay, we need to get to financial independence. And even back then, I was thinking, if I had $1 million and it just kicked off just 5%, I could live on 50 grand, because at that point I was making 70. Um, uh, the bad job unfortunately led to the dissolution of my common law marriage as well, and the money that my ex got was actually more than I made in that bad job during those 1.5 years, however long I was there, despite a prenup. So I started contracting at that point, got incorporated. So in 2008, I got laid off and was home for 9 months. And I'm like, hey, this is awesome. I really want to do this for the rest of my life. And then I started contracting because I got let go so many times, never fired, but laid off a lot. That I'm just like, well, there's still no job security. Why don't I just do contracting? You get paid pretty much twice as much. And with a corporation, it was all very tax efficient for active income. And I just started investing. And every spare penny that I had, I live very frugally. To this day, I live on 30 grand a year. I've never owned a car. Since my ex left, I never had access to a car on a regular basis. And I just kept contracting from like 2009. My last job ended 2020, and January, nothing to do with COVID. And during that time, my my net worth like tripled, and I never knew how much was enough. And then I ran into a project which I knew was going to be a disaster and unpleasant, and I'm just like, all right, we're done. It had to be that finally pushed me over the edge. So, and then since 2020, I've been enjoying life. My net worth almost doubled yet again, just during those 5 years, because you had 2020 was great, 2021 was great, 2022 was not. I think I lost about 10%, but it wasn't as bad as the NASDAQ, which lost 30. And then 23 and 24 were very good again. So anyways, work hard at the beginning, live on less than you make, what you want out of your life. I was investing 85% of my income at the end, 85%, because I was making $250,000 and living on 30. So everybody has to do what they want. Of course, always single, no kids, doing that. So I was making those decisions for myself. Anyways, Paul says, just transferred my RSP to All Simple, so you're getting the 2% match. Yeah. RBC only transfers in cash for some reason, so I got to start a new portfolio. Any suggestions for some ETFs for 30-year time frame? Paul, you are in the exact same situation as I was until recently. I don't know if you heard me earlier. I'm going to do a video this weekend about the whole process, but I will just to not leave you empty-handed. So if you had mutual funds in your RSP in Royal Bank, which a lot of brokerages will take or have mutual funds, including, I'm sure, RBC. But Wealthsimple doesn't take mutual funds. So I ran into that as well, and I knew that. So I liquidated all the mutual funds in my portfolio, not pulled them out of the RSP, just changed them to cash. Yours, I'm assuming, got changed to cash in transit. I did mine ahead of time, and then the transfer was a lot faster. It seems like I started another account's transfer a week before the RSP, and that still hasn't all come over, while the RSP came over last week. So I'll tell you what I bought. And like I said, I'll do a video this weekend, screenshots and everything. Hold on. So I did XIU, so that's TSX 60, so that's covering Canada. I did that, I think, I want to say 15%. No, 10%. 10% of the money. S&P 500 index, so that was VFV. That's sort of the standard that everybody uses. That was 5%? No, 7? Anyways, I underweighted it because I think US is fairly overpriced. Still to this day. Then to cover developed markets, I put in XEF, so X-ray Echo Foxtrot, and that's the index is EFI, so Europe, Australasia, Far East, but it's developed. So developed Europe, UK, and Western Europe. The Asia is Japan, basically. Sorry, the Far East is Japan. Asia, I'll have to look whether it includes China or not still. And then I have emerging markets, so VEE, so Victor Echo Echo. And then to spice up my life a little bit, I got myself US small caps. So that's basically the Russell 2000, because those will be volatile but will outperform over the long run. And I got myself TD Global Tech Leaders. So that's Tango F Echo Charlie, TEC. And then to calm down my life a little bit, I got World Bond ETF. So Capital Group World Bond ETF, CAPW. That's the only one that's positive since Friday. I bought all of this stuff on Friday. So I covered the world geographically, picked a couple of with technology and small caps. And then if I need to pull some money out, because I'm going to be starting to pull my RSP money out in about 8 years at 60, because it's about $500,000. So I don't want it all happening when I turn 71. So especially, I would argue the technology and the small caps will do well over a long period of time, but you'll get a lot of volatility. You could just do the geographical, the 4 that I said first. So Paul, I hope that helps. Like I said, I'll do a video. Well, I do one every weekend, but a guy says, so prenup didn't really protect you. Well, it saved me money because at that point our net worth was about 900, and she got 250. If I waited a couple of more years, she would have gotten 450. She would have gotten half of the 900. So it saved me about 200K. But basically the way it was written, and it has to be fair. If it ever gets challenged, a judge could throw it out if it wasn't fair. So basically we said, what we have coming in is ours. No sharing of pensions or anything like that, which I'm not going to have anything anyways. But what we said was, from this point on, anything that we make together, we would share halfway. So she shared on the appreciation of the house and whatever money we made basically during the time we were together. So that was the other 200,000. The house appreciated about by then maybe not. The house may be appreciated by 50, maybe 70 grand, and the rest was basically salaries. So she got half of hers and half of mine. Yeah, like it can't be you walk away with nothing, right? If it ever got challenged, that would probably get thrown out. This was in BC. It also has to be reviewed by different lawyers, and it has to be reviewed. Otherwise, it's not worth the, like they have to get legal advice. Everybody does. Otherwise, it's not worth the paper it's written on, and witnessed and everything. So going to our friends / neighbors was a little embarrassing to try to get the witness. So yeah, it helped, but yeah, like it wasn't that she was gonna get nothing. Paul says, I don't invest a ton into RSPs because I'll be drawing a pension. Good for you. Mostly just into the TFSA. Yeah, the ETFs that I mentioned, I've got very, very similar things in my TFSA. If you want to look, I do publish my portfolio. It has not been updated for the RSP yet. I update it once a month. But you can go CanadianMoneyTalk.ca, check my portfolio, go to my portfolio and scroll all the way down, and you'll see my TFSA, which has, I think two of the ETFs are the same, and then 2 are different, but basically geographical again. TSX, S&P 500, developed markets, emerging markets. That's in my TFSA, so those will work. In the TFSA, you have the 15% withholding on the foreign dividends, but the stuff doesn't really pay anything. The S&P, I think, pays the most, and that's 1%. So they withhold 15% of 1%, so 0.15. So TFSA is still fine. Roman Miller says, do you think the U.S. will go into a recession? That doesn't seem to, and in my opinion, is coming from the talking heads and economists and all of that. If the trade war persists, Canada will. The U.S. will. The GDP growth will slow, but it didn't sound like anybody's base case was that they would go into a recession, because Canada doesn't really, like, we're just not big enough to damage the U.S. Mexico maybe a little bit more. The U.S. will definitely damage Canada if the tariffs persist. So no, it doesn't. Like like the economy isn't firing on all cylinders in North America anyway, and this will just slow it down for the U.S. and put it in reverse for Canada, right? That Canada also has a problem with not keeping up with productivity that the U.S. has been increasing. Canada hasn't been keeping up with that. So that's another reason why the U.S. is ahead. Anyway, yeah, Paul, you're welcome, no problem. Jimmy John says, if someone can live off 40,000, how much would they need in their portfolio to retire comfortably? So 4% rule, easy math on this one, you would need a cool million. It's 25 times what you think you can live on. The 4% rule, I've also recently, it's been updated multiple times. The most recent one was you can pull 3.7% for it to last for 30 years. The retire comfortably, Jimmy, in your question is the 40,000, right? If that's not comfortable, then you need to change the number. But basically, for the 4% rule, you take what you live on per year and you multiply it by 25, and then so that's where I arrived at the 1 million. And then you can pull 40,000 from it the first year. Next year, 40,000 plus inflation adjustment. That's how the 4% rule works. That is supposed to last you 30 years. I think with like 95% chance of you not running out of money. So if you think you'll live longer than that, pull less. Like I said, maybe instead of 4%, pull 3.7. So if you can comfortably live off of 40 grand, which with a paid off house and kids out, maybe just one car, I guess it depends where you are. If you're in Vancouver and you're renting, if you don't even have a paid off house, then 40 grand isn't going to do it. So track your spending. You're not going to need to be investing once you're retired. So that's one benefit. The kids are out of the house. The mortgage is paid off again, depending on your life choices. So maybe you won't need as much money as you're making today. If the experts say use 70% of your current income, but that really varies widely. Some people will sort of shut it down and not do very much in retirement. Others, and this seems to be the majority, at the beginning they'll spend more while they travel. It's called the retirement smile. At the beginning they spend a lot traveling while they still can. Then they sort of get it out of their system, and they visit the grandkids. And then towards the end, whether medical or extended care, living in a rest home and so on, can spike up the cash needs. So it's really hard to plan out, but you can sort of make estimates at it. So if you sort of eyeballed it and said 40,000, track your spending for 3 months, prorate, stuff like property taxes or whatever, insurance that you pay once a year, and you can sort of get a much better idea, because 40,000 sounds like a very round number. For me, going into my Quicken, if I look at, so I'm going to do for 2024, last year. So my expenses, and I also moved. So the move added to everything, and I was still paying condo maintenance fee for half a year. My total expenses were under 30,000 without taxes. Taxes, I paid 48,000, but some of that included the tax on the house in the investment property in the US that I sold in 2023. But I ended up paying the taxes on that in 2024, so that's why it's included here. So I won't get a true picture until end of 2026, really. This year it's looking like, in personal, I owe 40,000, but my the private, so the corporation, what was my refund? Oh, the corporation had like a $16,000 refund, so I'm gonna net about 24 grand in taxes for 2025 by the looks of it. So taxes, I'm very tax aware because they're the biggest cost for me. Yoshi Lee says correctly, it's dependent on what you spend per year, year after year. So I mean, it sounded like 40,000 from Jimmy. It could be overstating it. It could be understating it. I don't know. I think I would guess most people understate it, but I mean, you could be. I think people spend more than they think. Generally, they're surprised. Yoshi also says, what if you have to pay for chemo for your mom or bury your relative? How are you supposed to know how much you need to retire if anything can happen tomorrow? So today's estimate might be way off. Yeah, I mean, you should have an emergency fund, especially when you're retired. There's the concept of a bucket portfolio. Google that. I'll give you a quick rundown. 3 buckets. First bucket is cash, which is 2 years worth of spending, arguably your emergency fund as well. That's to prevent you in retirement. That's to prevent you from having to sell stocks if they've come down. You can live for 2 years off of the cash you have. It doesn't make you anything. It doesn't even outperform inflation usually, but it is there to prevent you from having to sell out of a market downturn. Second bucket, 8 years, so years 3 to 10, 8 years worth of spending. Large caps, bonds, maybe kicks off some cash flow, but safer. And then everything after that is in stocks, because over 10 years, stocks are the way to go. And then you spend out of the bucket that is appropriate, and the bucket 3, the stocks, is what's going to outperform inflation. You spend out of whichever bucket is appropriate. So if the stock market did great, you spend out of bucket 3. If the stock market did poorly, you spend out of bucket 1, because there's generally no market downturns longer than 2 years. That's why the 2 years. And if the market is still doing poorly in the 3rd year, then you start spending out of bucket 2 or refilling bucket 1 from bucket 2. In Canada, I don't know about chemo. If you're American, I can see how that could be bad. Burying your relative shouldn't be that expensive. I guess depends on what pomp and circumstance you want, but like 10, 20 grand, I would guess, right? So yeah, life can throw all sorts of, like, eventually you'll need another car, maybe your house needs a new roof, or if you want to spend 10 grand a year on traveling, like you need to factor that in, right? So Yoshi says, what do you think of tariffs? Will the market collapse? I don't think it'll collapse. My base case is that it'll last for, I'm hoping, a month, 2 at the most, which I think the market's sort of priced in. And then they'll say, okay, we've been stupid long enough. Let's come to an agreement. Right now, everybody's just posturing and rattling their sabers, whatever you want to call it. So no, Canada would go into a recession. Even today, preventively, the Canadian Central Bank cut interest rates. The US, the GDP growth will slow. The US economy isn't going gangbusters as it is. It's definitely not firing on all cylinders. This will slow it. The economists that I listened to didn't seem to think that it would go into a recession in the US. Like, Canada is just not gonna make a big enough impact, even together with Mexico. Um, the U.S. though it's actually more that that Canada put the reciprocal tariffs on, that action could put Canada into a recession. Uh, Tariffs generally harm the country that put them on. It's all just increasing prices for the consumers of the country that put them on. So it's another tax on the poor, basically. The tariffs are. Canada reciprocating could mean that we'll go to the bargaining table and that everything will get taken off, but the tariffs will harm Canadians that the Canadian government put on. Cargo says, "Do you play games?" I'm gonna assume video games. I do. I play very old video games that run on my very old computers. Um, yeah. Uh, Beth says, "I live in the United States. I think we won't go into a recession." I think you're on the yet. Yeah, I don't think the tariffs will do that to the U.S. Like, Trump sort of knows that he's got the upper hand, which is, I guess, why he's doing it. It's not going to make the American economy anything amazing. I don't believe. Jimmy says, "Sounds like Trump is in it for the long term with the tariffs, and he keeps hinting that April 2nd is just the beginning." He also waffled quite a few times. I hear what you're saying. I mean, some of the guys in the Vancouver investing club are like, we think this is gonna persist. Most experts say that it's just a bargaining chip. It's going to bring everybody to the bargaining table. Trump is going to make himself feel important by redoing the trade treaty that he himself did in his first term. It's going to be exactly the same. Nothing's going to change. He's just going to tell everybody that it's different. Or if the tariffs will come off. If they do persist, the thinking is that it's not going to be 25% or 50% or whatever else is sort of in the works. Time will tell. Trying to time the market, like I mentioned, I invested close to $500,000 in my RSP because the money came over in cash from Qtrade into Wealthsimple. Like, for me to sit on the cash, and then see an update, it's like, oh my God, I'm missing out. It's like, as soon as I have the money, I put it in. I honestly don't try to time it. So it could get worse for sure, or they could shake hands tomorrow and it'll be fine. Maybe Carney's gonna go see Trump. Maybe Trump will like him better than Trudeau, who maybe he didn't like him that he was younger and good looking. I have no idea. Or that Trump's wife liked Trudeau better than Trump. Who knows? It could very well get worse. Like, there's no winners in a trade war, in all honesty. So, like, everybody will get damaged. In the end, they'll come to the bargaining table. There is stuff that Canada has that the U.S. needs. I own Nutrien, which produces the potash which the U.S. farmers need, and their share price went down. You would think, which I guess it sort of makes sense, but at the same time, it's like, well, we have a very key bargaining chip here. The whole thing with Russia is just putting yet another weird spin on it, that allegiances are changing and that they're taking off the sanctions, and like maybe they'll get potash from Russia now. Like, I don't know whether he's just trying to show himself as a big man, or that the dementia is finally kicking in. But yeah, U.S. just being world's biggest economy, 10 times Canada's population, 10 times Canada's GDP at least. It's going to be the U.S. sort of comes out ahead in terms of the economic damage, meaning they'll get less economic damage, but it will hurt them. I don't know about shutting off power and all that other stuff that sort of came out. Like it becomes a lot of posturing. It's like, okay, you took U.S. alcohol off shelves. It's 1 or 2% of whoever sales, so it's not really gonna make a dent. But anyways, any other questions? I'm sort of Canada cut interest rates preemptively, 0.25%. Our unemployment has been sneaking up. I think we're in the high sixes now, last I looked. But our inflation came off at least. So, tariffs could they'll cause inflation for sure, but like to recessions happen on their own often enough to artificially create them is, with your best friend. U.S. seems to like Canada better than Mexico, so like I think Canadian feelings were hurt more than anything else. I don't know. Anyways, if there's no other questions, the other thing I had happen a couple of times was the comments weren't coming in for like 10 minutes. Nothing was happening. So I'll be patient. And then suddenly all of them dropped in once, and then the second time I just ended the session. So I won't bore this if it's different people. I can tell the story of how I got to financial independence, and not to brag, but the 6.2 or 6.1 million net worth. If everybody who's on heard it the first time, I can tell you a different thing, but you need to tell me what you want to hear. Yeah, I was the other thought that I have repeatedly when I go for a jog is, like, oh, it's working. AMD. Just to finish my thought, it's like getting to financial independence and getting to millionaire status. I mean, by the time you get there, it's not going to be the same as millionaire status today. Just like today's millionaire isn't the same as it was 20 years ago, right? Today you kind of need 2 million in order to have that same value. But it's like, look for stuff that has low fees and or outperforms the benchmarks. If you can avoid it, don't have a financial advisors. The ones at the bank especially just have just want to sell you overpriced, poorly performing mutual funds. Just do low fee ETFs and just automate it. Just invest something regularly every month. And then what kind of life do you want to live? Do you hate your job, or is your job okay? Are you willing to work another 10, 20, 30, 40 years if you're 20 years old now? If yes, then, put away, I'm making this up, $500 a month, and you'll be fine, especially if you have some sort of a defined benefit pension. If you don't have a defined benefit pension and you're like, okay, I hate my boss, I'm not going to survive in this job for very long, consider changing jobs and bosses and or careers. But if you want to do what I did and you save and invest, so you don't have to work at all anymore, rather than beginning another career somewhere from scratch, then the $500 a month isn't going to do it. Like, do 1,000, and then when you have spare money, throw that in as well, right? It just depends on what you want from life. Or say, yeah, like my job, I want to spend time with my family. I want to take them on vacations. Okay, that's the decision you're making, right? You're probably not gonna be able to leave your job before 65, but that's who you are, and that's fine. You only live once. Anyways, enough of my speech. So AMD, wow, that's quite the chart. So I think Intel is sort of gone. Like, they're certainly not investable. Like, I don't really know what they've got going on. I wouldn't put money into it. So no dividend. Price to earnings is 96. So it's definitely a growth stock. Like, at this point, I'd rather buy Nvidia, which I looked today was in the 40s, I think, or 30s, 30, 36 maybe. So AMD is selling less and has, I guess, lower profits. Their share price went down over the last year a lot, and they're still overpriced in terms of PE. So, like, they could drop down to $50 a share, and their PE with the current profits would be in the high 40s. So I still wouldn't buy them. I'm not a growth investor. Like, I really need stuff to be cheap, and there's still a lot of future profits priced in. I'm assuming the share price has been going down because their profits have been coming off, but apparently it hasn't gone down far enough. So their sales are increasing quarter over quarter, but their profits, yeah, for sure. Profits have come down. So yeah, for me that's a no. It's if you're comfortable with it, you're getting it at a much better price than a year ago. But like, I'm not, I can't buy stuff like that. Any I looked at Nvidia. ACMR ACM Research sounds like. Okay, never heard of them, so this is going to be just on the numbers. Okay, very different chart, especially since December. They're at 27. P is 17. What do they do? Development, manufacture, and sale of single wafer wet cleaning equipment. Oh, okay, this rings a bell. Supplies, semiconductors. Yeah, but they don't have an economic moat, if memory serves. Yeah, so like, somebody else could step in and just charge slightly less for whatever cleaning equipment, and put them out of business. Like, there's nothing that prevents the chip manufacturers from using a different vendor for this. I guess to that end, they're cheaper. Not much debt. Return on equity is 12, so that's not bad. No dividend. And by the way, just shameless plug, I created a couple of courses, one for basic personal finance and one for stock analysis. I call it the advanced course. So all the stuff and much more that I'm sort of going through when I look at a stock for you is in the course. So CanadianMoneyTalk.ca, take a look. They're $50. I'm not charging $800 for a course, and it's like they're 5 or 6 hours of recorded video. Sorry, the dog is just leaving. I think. Increasing profits, that's good. Year over year. Increasing sales year over year. Even quarter over quarter, they're increasing sales and profits. Wow, that's a perfect chart or perfect financials. Yeah. I mean, they're not expensive. I mean, arguably they're a technology company. I mean, they're classified as industrial machinery. They're not, even after the run up, they're not that expensive. Yeah, it's just that they don't have an economic moat. So competitors could easily replace them, or I could start a new company and probably get a couple of chemists together and you're good. So yeah, not bad. I'm not gonna run out and buy it, but they had their highs in January of 2021 where it looks like they were in the 40s, if not 50s. So they could come back a ways. They've also had a good run though. Anyway, yeah, not bad. Himanshu, hello. I'm well, thank you very much. There's a name I recognize. I can't remember when we last had contact or when you last watched one of my things, but I moved to Edmonton from outside of Vancouver eight months ago. Acclimated fairly well. Got a dog. still doing the same stuff. Anyways. So yeah, ACM research, not bad. Like at least they're profitable, and I don't think they're that expensive. Analyst price target has them as $33 being the 12-month fair market value. So you got a tiny bit of you got what, 20% upside, give or take. 25% upside. So yeah, not bad. Anyways, yeah, I'll talk about the tariffs briefly, and if you have any other questions, feel free. Otherwise, I'm gonna call it a night. I do this every Wednesday, but alternating on YouTube and on TikTok. So on TikTok, same channel name, Canadian Money Talk. So next Wednesday is going to be on TikTok. I start 6 p.m. Eastern, 6 p.m. Pacific, 9 p.m. Eastern, 7 Mountain Time for me is when I start. YouTube ones are way calmer because I get behind with the number of people on TikTok, but whichever you prefer. And I answer personal finance questions, Canadian stuff, a little bit about taxes, not US taxes though, but Canadian taxes I'm pretty good with. If you're interested in incorporating, I know a little bit about that, having been incorporated for more than a decade. Yeah, personal finance, investing, early retirement, or whatever you want to make it your own. So yeah, the tariffs I'm hoping are temporary. It's sort of my base case. I don't think that 25 or 50% or whatever numbers they're up to now are sustainable. Like things would just sort of slow down to a halt. The reciprocal tariffs could cause a recession in Canada. They won't cause really anything in the US. The tariffs hurt the country that puts them on most, because the tariffs are paid by the importing company. So when US puts 25% on, it is paid by the US importers. Now they can do various things. They can say to the Canadian or Mexican or Chinese company, say, hey, you need to give us 25% off, otherwise we can't do business. Depending on the power dynamic. Or they could say to the consumers, you're footing the bill, and just increase the prices, or a combination of the two. It's not black or white. Over a longer period of time, choice number 3 could happen, where stuff is going to be made in the US instead. But the reason why it's not being made in the US today is because the US is more expensive than all the other countries. And so the product is going to be more expensive for the US consumer anyway. So in 2 out of 3 of those, the US consumer ends up paying for it. And it's basically just an extra tax that Trump can then use to lower taxes on US corporations, right? Why not? Now, by reciprocating, by doing the same thing, we in Canada, we're hurting Canadians. But arguably, we are forcing Trump to come to the bargaining table. But it is hurting Canadians as well. And the reciprocate, I don't know if that's a word. If the tariffs that the Canadian government is putting on, they could put Canada into a recession. So we've had the Canadian Central Bank cut only 0.25%. It was sort of expected, but nobody knows what will happen with the tariffs. Like if the tariffs persist, they will cut more to stimulate the economy, because it will be a drag on the economy, and it could cause our GDP to go down. So US will feel it. Maybe the combination of the three countries, Canada, Mexico, and China, maybe together we will hurt US producers as well. Who knows? It really depends on the power dynamic, and if there's alternatives. So like US alcohol, like it's the US companies that export alcohol to Canada, they say it's 2% of their sales. So it's not tragic. But if you add the countries together, and as long as there's alternatives, as long as there's Canadian producers who are able to fill in the void, we can cut US alcohol producers out. It won't hurt them. It'll help Canadian companies. So that's case number 3, where the production transitioned to the country that is putting on the tariffs. But that doesn't have to happen. It could just be passed on to the consumers because there's no viable alternatives in country, and the exporting company isn't willing to foot any of the bill. So it's all going to get passed on to the consumers. So it really depends. Anyways, I'm not sure if it's a bug with YouTube's. Occasionally the comments stop showing up, and then they all jump in all at the same time, or whether there's just no questions. But anyways, I've been at it for 2 hours and almost 20 minutes. So I don't know if you guys want to hear anything else, but I told my life story previously from a financial point of view. Talked about the tariffs a bunch of times. So I kind of feel like I've covered all the bases. So whether the comments are not coming through or nobody just has any, I'm sort of thinking about calling it a night. Any last minute? I'm gonna go play with the dog. or more accurately see what she's up to. Okay, well, if the comments aren't showing up, I am sorry. Can I do anything with it? It doesn't look like. So I'm gonna wish you guys a good night. Sorry if you typed in a comment or a question and I can't see it, but it looks like a bug. So I will do this again in 2 weeks on YouTube and next week on TikTok. So feel free to join. I want to keep everybody involved. Also, you can find my email address and so on canadianmoneytalk.ca. The email address is canadianmoneytalk@gmail.com if you want to reach out. And I will be doing this weekend, I'll probably try to put it together tomorrow, a video about my recent move of my RSP from Qtrade into Wealthsimple and purchasing 7 ETFs on Friday for my entire RSP. So sort of starting the portfolio all over again. So maybe that'll be interesting. Cool. Okay. Sorry if I can't see your comments or if there just weren't any. I'm going to call it a night. Everybody be safe, and I will see you later. Bye.